In normal times, money is presented as neutral, technical, almost natural. We accept the comforting fiction that monetary systems are mostly fixed rulebooks, operating under clearly defined constraints. Under this peacetime fiction, we accept a specific set of rules. We believe central banks operate independently from politics, assume markets set prices without government intervention, and treat bank deposits as private liabilities that bear their own risks. Then, a panic hits. The moment the financial system fractures, those boundaries evaporate. Central banks suddenly backstop the entire economy, and the state swiftly absorbs private liabilities. The reality is that monetary systems are frameworks of trust and political promise rather than fixed rulebooks. When a state feels its own survival is threatened, those promises become highly negotiable. In a crisis, the government quietly and deliberately redesigns what money is allowed to be. For generations, the gold standard served as the ultimate rule of finance. A currency's value was strictly defined by the physical metal held in reserve, guaranteeing that notes should always be redeemed. But in 1797, Britain's war with revolutionary France triggered a severe financial panic. The public rushed to the Bank of England, draining its gold reserves down to critical levels. The government responded with the restriction period, simply suspending the legal obligation to convert banknotes into gold. This gave the state the financial room it needed to breathe. This shift occurred again in 1931. Under extreme economic strain, the United Kingdom abandoned the gold standard, discarding a monetary creed that had defined financial credibility for decades. Orthodox rules like hard money remain in place only as long as the political cost of defending them is lower than the cost of walking away. When convertibility threatens survival, survival wins. Before 2008, the central bank's job was described in narrow terms: set short-term interest rates, provide ordinary liquidity to solvent banks, and maintain a respectable distance from fiscal politics. That perimeter vanished when the global financial system seized. Lehman Brothers failed, funding markets cracked, and banks stopped trusting one another. This chart shows central bank balance sheets leading up to the crisis. As the emergency intensifies, the balance sheet erupts into massive growth. Central banks rolled out negative interest rates and began purchasing enormous quantities of sovereign bonds and mortgage-backed securities. By buying assets at this scale, central banks directly altered market structure. They suppressed term premia, the extra yield investors demand for the risk of holding longer-term bonds, effectively pricing risk by decree. When the state steps in as the buyer of last resort, market discipline is suspended. Certain markets are simply too important to be left to the volatility of independent repricing. The 2020 pandemic forced yet another expansion. What began as a public health shock mutated into a severe global dollar funding crisis. Central banks and fiscal authorities moved in tandem, pumping liquidity into all corners of the financial system to prevent an economic freeze. This time, the mandate expanded further. Central banks stabilized corporate funding channels and organized international swap lines to protect dollar liquidity across borders, moving far beyond the defense of commercial banks. To execute this rewiring, governments used three quiet tools: the suspension of ordinary collateral rules, the guarantee of private risks, and direct control over capital flows. By 2020, central banks were actively redesigning the entire global monetary and financial architecture in real time. A crisis does not only threaten a monetary order, it reveals which parts of that order were conditional all along. It strips away the technical, apolitical facade of peacetime policy and exposes how the system is truly wired. This crisis-time X-ray reveals money as a flexible weapon of administrative survival for the state. We are now entering an environment of high global debt, geopolitical fragmentation, and experimentation with tokenized digital infrastructure. The next major rewiring will likely stem from the hidden linkages between traditional banks and non-bank financial institutions. In this network, a local liquidity strain can quickly spiral into a system-wide panic. When that moment arrives, the state rewrites the definition of money itself to preserve its own capacity and continuity. Once you recognize that money is political infrastructure, future financial emergencies stop looking like unpredictable anomalies. They are simply the moments when the state rewrites the rules to survive.